Ladies and gentlemen, good day and welcome to the Q2 FY 2026 earnings conference call of Aurum Proptech Limited. As a reminder, all participant lines will be in the listen only mode and there will be an opportunity for you to ask questions after the presentation concludes. I now hand the conference over to Ms. Vanessa Fernandez. Thank you and over to you, ma'am.
Thank you, Sagar. Good afternoon, everyone, and thank you for joining us today. A warm welcome to the Q2 FY26 earnings call of Aurum Proptech Limited. We are joined today by Mr. Ashish Deora, founder and CEO of Aurum Ventures, Mr. Onkar Shetye, Executive Director of Aurum Proptech, Mr. Kunal Karan, CFO of Aurum Proptech, and Mr. Rihen Shah, Strategy and Investor Relations. Q2 marks yet another important milestone in our journey. It has been a period of steady execution and disciplined growth, a quarter where our focus on profitability and operating efficiency has begun translating into tangible outcomes. The progress we've made reflects not just operational maturity, but also the expanding scope and scale of our platform as we continue to align our businesses to transform the real estate experience for all stakeholders. Before we begin, I'd like to remind you that certain statements made during this call may be forward looking in nature. These are subject to risks and uncertainties as detailed in our annual report and investor disclosures available on our website. With that, I'll now hand it over to Mr. Ashish Devra to share his opening remarks.
Thank you, Vanessa, and good afternoon, everyone. It is my pleasure to welcome you to the 18th earnings call of Aurum Proptech, and it's my privilege to share with you our performance for this quarter. Q2 FY 25-26 is a pivotal and landmark moment in the journey of Aurum Proptech. Since inception, we have consistently articulated our drive of profitable growth. Q2 of financial year 25-26 is our first profitable quarter on adjusted EBITDA basis. This is due to our focus on relentless execution, unit economics, financial discipline, and unwavering pursuit of profitable growth. The credit for this exceptional performance goes to deep ownership mindset of every team member who believes in Aurum vision. Our purpose has always been bold: to build India's largest and most trusted integrated PropTech ecosystem. With each passing quarter, we are seeing the network effect strengthen and compound. Our platforms are now enabling home buyers, developers, and stakeholders across the real estate value chain, making the ecosystem smarter, faster, and more transparent. Let me now share some financial performance for this quarter. Our revenue grew 30% year on year, and we saw our PBT margin improve by almost 1,000 basis points. Most importantly, we improved our adjusted EBITDA percentage by 700 points. From minus 4% in Q2 FY 2025, we are now plus 3% in Q2 FY 2026. Also, this is the first quarter where the revenue of our rental business has delivered a 200 crore ARR. We believe that our distribution vertical, with the addition of PropTiger, will also soon deliver 200 crore ARR. So across our verticals, we are targeting to deliver 500 crore ARR in next few quarters. Needless to mention, we will keep a very keen eye on the profitability. I am also excited to share with you the successful completion of PropTiger transaction. We now own 100% shares of PropTiger, and we look forward to engaging with REA Group as our shareholders. We believe that REA has deep knowledge of global real estate platforms, and at Aurum, we should broaden our engagement with REA across the shared value of innovation, governance, and long-term value creation. Going forward, other than improving our financial metrics, our day-to-day focus remains on three things. First, harnessing AI to accelerate product innovation. Second, to deepen consumer obsession in everything we build. And third, to strengthen our digital-first DNA across our organization. What truly empowers Aurum is our people, our entrepreneurs and leaders who think like founders, execute with purpose, and carry the conviction that Indian real estate can be and will be reimagined. To conclude, earning calls is where I get to interact with you and is very special. It always reminds us of a larger purpose. And today, this earning call is even more special because I get to wish you and your loved ones a very happy Diwali. Together, we are reshaping the future of Indian real estate, one product and one home at a time. Thank you for your continued trust and partnership. With that, I now hand over the call to Omkar. Thank you.
Thank you, Mr. Deva. The second quarter of FY26 marked another period of consistent execution and improved profitability metrics for Aurum Proptech. Our focus on operational excellence, customer-centric innovation, and technology-driven scalability continues to strengthen our integrated property ecosystem across rentals, distribution, and capital vertical. The rental business sustained its growth momentum with 54 crores in revenue, up 25% year-on-year. The segment continues to benefit from tech-enabled service upgrades and improved customer experiences across our brands Hello World and Nestaway. We added 19 buildings, bringing our managed portfolio to 258 properties with over 19,000 beds and an overall occupancy of 73%. Importantly, 128 properties maintained over 80% occupancy consistently throughout the quarter, underlining the strength of our demand base. Hello World enhanced its digital offering through upgrades to short stays model, a new review and ratings feature, and a smart meter integration for utilities, driving better tenant engagement and operational transparency. On the expansion front, we are pleased to share that Nestor, our Dubai operations, were launched during Q2 FY26, marking our first international foray into the Middle East rental ecosystem. Nestaway continued to improve unit level profitability and achieved a 4x growth in monthly revenue run rate in secondary sales, supported by recently launched digital resale platform. This initiative enables us to leverage long-standing relationships with property owners to unlock an additional high-margin revenue stream. Our distribution vertical delivered another strong quarter of data-driven growth with 27 crores in revenue, a 62% year-on-year increase. Aurum Analytica sold 95,900 leads to 140 active clients across 250 projects, representing a 53% growth in lead sales over the same period last year. We launched operations in 5 cities, with Pune and Indore scheduled to go live in the coming quarter. The MVP of our next generation Analytica platform was initiated this quarter, integrating AI SEO capabilities to boost organic rankings and expand reach in tier 2 markets. The Sell-to CRM business continued to scale with 170 plus enterprise deals closed and 1,400 new licenses added during the quarter. We also strengthened partnerships with marquee clients such as EXP Realty, Peninsula Group, and Taj Sky. Our AI-enabled product stack delivered measurable productivity gains with engineering efficiency up 35%. New features such as call transcripts, translation, and AI insights added, and the first 2 customers onboarded for our AI calling bot service. Capital. In our capital vertical, Amza Investments, a subsidiary of Aurum Proptech, is progressively steadily following SEBI's approval to register SM REIT. We are evaluating a robust pipeline of grade A income generating commercial real estate assets and will adopt a prudent approach before launching the inaugural scheme. We continue to uphold strong governance, risk, and compliance practices with board level oversight across key focus areas to ensure sustainable value creation for all stakeholders. In summary, Q2 FY26 has been a quarter of steady expansion, improved efficiencies, and strategic progress. We have expanded our footprint both geographically and across service lines, deepened our technology stack, and become operationally profitable. I will now hand over to Mr. Kunal Karan, CFO, to take us through the financial results.
Thank you, Omkar. Thank you everyone for taking out time to join us on this call today. First, I would like to state the following events that occurred during the quarter, which have an impact in the financial statements. During the quarter, the company has invested in 100% equity of PropTiger Marketing Services Private Limited for a consideration of INR 86.45 crore. The purchase consideration was settled by issue of 42,42,537 fully paid equity shares of the company. Control was obtained on September 25, 2025, and the current results include the performance of PropTiger for 5 days. Effective July 1, 2025, considering a prospective restructuring of Integro Asset Management Private Limited, the company has kept its board control rights in abeyance till March 31, 2026. Integro has been considered as an associate for the quarter ended September 30, 2025. Now the results. The revenue from operations for the quarter was INR 82.50 crores as compared to INR 68.40 crore in the previous quarter, an increase of 21%. The total income was INR 87.66 crore, an increase of 14% as compared to the previous quarter. Loss before tax for the quarter was 6.96 crores compared to INR 10.78 crores in the previous quarter. The results compared to the corresponding quarter previous year. Revenue from operations grew 29% from INR 63.96 crore to INR 82.50 crore. Total income for the quarter grew by 30% from INR 67.61 crores. The loss before tax for the quarter was 6.96 crores as compared to 12.07 crores in the corresponding quarter previous year. The result for 6 months ended September 30, 2025. Revenue from operations was INR 150.90 crore compared to 120.85 crore, an increase of 17%. The total income was INR 164.6 crores compared to 136.7 crores, 20% year-on-year growth. Loss before tax was INR 17.7 crores as compared to 25.8 crores in the last 6 months. EBITDA improved by 82% year-on-year. The balance sheet. The assets of the company as on September 30, 2025 was at INR 905.84 crores and the total liabilities at 413.9 crores. The total borrowing is 61.82 crores as compared to 81.01 crore as on March 31, 2025. Cash and cash equivalent was INR 153.89 crores as on 30th September 2025. The segment results. Revenue, the rental revenue contributes 65% of the total revenue at 54.11 crores, and distribution and capital segment contributed 27.19 and 1.2 crores respectively. Segment results. Rental and capital segment had a loss of 3.6 crores and 0.35 crore respectively, while the distribution segment made a profit of INR 5.51 crore during the quarter. Thank you.
Should we open the floor for questions?
Yes.
Thank you very much. We will now begin with the question and answer session. To ask a question, please click on the raise hand icon tab available on your toolbar on the Q&A tab available on your screen. Kindly turn on your mic when the operator announces your name. You may also post text questions. Participants, to register for the question, you may click on the raise hand icon tab available on your toolbar or on the Q&A tab available on your screen.
Sagar, the Q&A section says it's now closed. Can you just check it at your end?
Sure. Ladies and gentlemen, to ask a question, please click on the raise hand icon tab available on your toolbar or on the Q&A tab available on your screen. We'll start with the text questions and we'll take the first text question from the line of Mr. Anubhav Anil Goel. And the question is, can you name other real estate CRM companies for comparison? Sell, Do, and Aurum Analytics. Which would you be competing against?
Hi, Anubhavji. This is Rihin here. Thank you so much for your question. Sell.do is the real estate CRM that we have, one of the oldest real estate CRMs that is operating in India. Overall, its competitors in terms of features, it competes with the likes of Salesforce and Lead Squared as well. However, at a real estate level, it is the best rated CRM across the real estate CRMs that are there in India. So if we draw comparisons, we can draw comparisons to the likes of Salesforce, Lead Squared, and Zoho as well. For Aurum Analytica provides leads to real estate developers. So while in the market it competes with the likes of 99 Acres, Magic Bricks, it's a very different value proposition where it goes with a hyper personalized targeting of real estate. While a 99 Acres or a Magic Bricks would have a proposition of a branded marketplace, this is a very hyper personalized targeting of real estate advertisement. So that's the primary difference, but these are the competitors that we generally track. Thank you so much.
Thank you.
Thank you.
Our next text question comes from the line of Sunil M, who's an investor. And the question is, what percentage of Aurum does REA own now?
Thanks for the question. It gives us pleasure to also brief you about the REA transaction that started last quarter. We have successfully gone on to execute the transaction. Both teams work together to ensure that there's transition across the board. REA now holds 4.5% at Aurum Proptech, and we are really glad that they have taken this leap of faith in the India PropTech ecosystem with Aurum PropTech.
Thank you. The next text question comes from the line of Mr. Param Vora. And the question is, Mr. Param Vora from Trinetru Asset Managers. And the question is, the rental business is around 60% of revenues. How do you intend to grow the non-rental segments over time? Within that, which sub-segments do you see scaling fastest and why?
Thank you, Param, for your question. The rental segment does currently account for 60% of the revenues. However, with integration of PropTiger, we believe that the split of rental and distribution will come to around 50-50%. 50% of our total revenue will come from rental and other 50 will come from distribution. In the current quarter, only 5 days of PropTiger revenue was consolidated. Overall, we feel that going ahead, both the segments will grow, in terms of all the products. Aurum Analytica as a product has grown 60 to 70% year-on-year basis in all quarters. We see that as one of the high growing companies as such. Along with that, we've recently acquired PropTiger, but we see really strong green shoots and ecosystem level synergies where we are seeing the growth coming in from there as well. The rental segment overall will grow between 30 to 40% on a YOY basis, which has been our consistent performance so far as well. Thank you.
Thank you. Our next text question comes from the line of Mitesh Jain, and the question is, the current rental ARR is 200 crore plus an additional 85% or post PropTiger integration. So, in how many quarters do you expect it to be at 500 crore ARR as stated? Did the current quarter have any contribution from PropTiger?
I think the current quarter we have taken 5 days of 5 days uh, of the Top Tiger revenue, which was not very significant, but because of the accounting reasons it was done. Having said that, the 500 crore ARR is expected within this financial year and should be achieved in the Q4 of FY 25-26, which is in the same financial year.
Thank you. Our next text question comes from the line of Vishal Gajra from Ambit. And the question is, can you throw a light on the acquisition of PropTiger? What valuation it happened at?
Sure. Uh, Hi, this is Rihin here. Thank you, Vishal, for your question. The PropTiger acquisition was a very strategic acquisition for a growth of our distribution value chain. While we were providing leads and managing leads through our two platforms, which is Aurum Analytica and Sell.do, PropTiger gives us an end-to-end distribution model where we enable the transaction management as well. The acquisition happened at a price of 86.45 crores. This was done through a equity share swap with REA India, where REA Group is now a shareholder in Aurum Proptech. We are planning to grow partnership with them, and we'll be delivering and enabling a strategic partnership for them in India operations. Thank you.
Thank you. Our next text question comes from the line of Mr. Anubhav Goel. The question is, can you give a breakup of sales for PropTiger by activity? Wanted to understand how is PropTiger, which we acquired, different from a 99 acres or a housing?
Thanks for your question. It is really important to bring out the differentiator between both these platforms. PropTiger earns its revenue from two streams. One is transaction management brokerage, and the other being facilitation of home loans. Presently, the transaction management brokerage is the largest component of the revenue stream, which is split in two parts. Transaction management revenue coming from annual operating plans signed by with real estate developers, where we go on to deliver sales for real estate projects in primary sales, and uh, the other being mandates, where we take exclusive mandates to sell real estate projects for real estate developers. So this is the split of the PropTiger transaction management revenue. The other revenue is the home loans facilitation, wherein any retail or home buyer who intends to purchase an apartment is looking to consult for his loan comes to PropTiger and gets the right recommendation. How are we different than housing.com and 99 acres? We are largely different. Housing and 99 acres fundamentally are only digital classifieds. Their promise to consumer, which is the real estate developer, the enterprise of a real estate developer, is that they will give leads against listings of real estate projects. PropTiger is a combination of a listing platform and also a transaction management team that has got presence in 8 cities. So any project that is onboarded by PropTiger is listed on the PropTiger website, either in a AOP or the mandate model. And of course, there's discovery happening on the PropTiger website, and the transaction teams go on to also facilitate or fulfill transactions for these. So it is it is basically enabled with lead gen capabilities and also transaction management capabilities, and that is how we are largely different from both these platforms.
Thank you. We'll take the next voice question from the line of Shivangi B from MK. Please go ahead. Shivangi ma'am, your line is unmuted. Please unmute the line from your end and proceed with your question. As there is no response from the line of current participant, we'll move on to our next voice question. And the next voice question comes from the line of Vishal Gajra. As there is the current participant, Mr. Vishal Gajra, dropped from the queue, we take the next voice question from the line of Rahul Jain from Daulat Capital. Please go ahead.
Hello, is my line okay?
Yes, sir, you're
Yes,
audible. Please go ahead.
Yeah, thanks for the opportunity and congratulations to the team for turning adjusted EBITDA profitable and also for completing this landmark transaction. I have one specific question for the Integro transaction and just trying to understand the repercussion of this from a going forward accounting perspective. If I go from the note to account kind of a thing, I can see that the entire revenue or deconsolidation impact is already been taken into current quarter's number. But it would be great if you could throw some more light in terms of what should be the annual revenue versus EBITDA differential because of this transaction alone.
Rahul, thank you for your question. I'll give you fundamentally why we have taken this action. When we did the Integro transaction, uh, we did not have the SM REIT regulatory framework uh, and guidance by SEBI. Um, SM REIT is a much more, I would say, agile instrument that is suited for commercial real estate properties of this grade than the classic AIF. And hence, we felt that we need to double down our interest in SM REIT, whereas we can look at Integro in a more subdued manner. Uh, Integro in the last 2 years was in an active GTM phase where they had done substantial investor relationship and investor build-up, also supply grading. However, the revenue scale was not as significant. Hence, from a revenue standpoint, you will not have as much of impact. You'll definitely have a positive impact in terms of profitability because Integro as a business is very people dependent and high quality resources are required to run that business, which come at a significant cost. This has now given us a lever to look at profitability with Integro being treated in subdued manner. I hope I've been able to answer your question.
Yeah, thanks for that color, Onkar. Basically, I would also like to understand whether this charge which has happened in this quarter as a share of loss of associate of roughly 2.55 crore, this is the 49% a part of the current quarter losses. Is that the understanding right?
yes.
Yeah,
That's
so Kunal, Yeah. So basically, If I go also refer to the capital business revenue from FY25, which was roughly 16 crore. So with this exercise, is it what kind of revenue run rate one could see could have been foregone from a like-for-like basis? Of course, you said it was not significant, but maybe some quantification.
The contribution of Integro in terms of revenue, if you see in the last quarter where we have consolidated the results as a subsidiary, was at uh, around 3 crores of rupees, which came into the capital segment, which will going ahead, that will not be available as a revenue in the capital segment. But
Sorry, it was not very audible, Kunal. If you could speak the number again.
look in the quarter one results, when Integro was considered as a subsidiary, the contribution of Integro was in terms of revenue was around 3 crores of rupees. Going ahead, this contribution of 3 crore rupees will not come in the financial statement because now with the change from a subsidiary to associate, there will be no line by line consideration of the performance of Integro in the financial statement. So these 3 crores of revenue from capital segments will move out. And the performance, as you have correctly identified, the performance, net performance of Integro will come only as a percentage, and it will get adjusted with the investment of Integro that we carry in the balance sheet. That
Right.
is how.
Yeah, sorry for harping a little bit more on this particular aspect. So just to understand the accounting, when we were in a JV structure, I'm assuming we were getting our share of revenue and our share of loss or profit. Now it is just a small fraction lower in terms of the consolidation. So we may forego the revenue, but the losses or profit number may not be very different from a consolidation point of view. Is that the understanding right?
No, no. So in the income statement, when it was treated as a subsidiary, the 100% income was reported and 100% of its results were reported. Now, going ahead, the income will not come. Its net performance, net result will come as a separate item, and only our percentage of holding, that is 49%, will be reported over there.
Right. So basically, the minority interest item is what is going to get reduced and it will show up rather in the share of associate line item.
Yes.
Right. And you said 3 crore as a revenue from Q1. Were you mentioning Q1 25? Because Q1 25 capital revenue overall was also lesser than 3 crore, it was 1.7 crore. Are you referring to Q2 of last year or you're referring Q1 26?
No, look, part of this integral revenue comes in the form of other income, so it was not contributing to the segment revenue, but it was contributing to the total income, so which doesn't come as a segment revenue index. If you say
Sure,
out
sure.
of
That's pretty helpful. And yeah, sorry, please go ahead.
out of the 3 crore, around 1 crore was there in the revenue, and the rest was there in other income.
Got it, got it. That's pretty helpful. And lastly, if I could ask one more, to Ashishji's comment where he was mentioning about the this business of distribution also getting into 200 crore ARR. I think that is pretty strong messaging in terms of the scale up of the business. So, of course, we are set for this 500 crore ARR, what you just alluded to. What should be our strategy in terms of we have to see from a really long-term perspective, maybe 3 to 5 years out. Will distribution be a bigger business for us to drive growth, or we would see the rental part of the business to drive that next level of scale up for us?
Rahul, thank you for your question. Um, so yes, there is a major scale up in the distribution segment. Rental, we are one of the largest rental management company in India, and now we are becoming larger in distribution as well. And we do believe that the distribution segment will deliver 200 crore ARR sooner than later. Going forward, when you look at a longer term vision and execution, the rental and distribution both will have similar contribution and same focus from our side. We believe that both businesses are very strong. Both segments are very strong. The TAM is very large. There is a huge need to reimagine the entire segments, and we have grown at a very large percentage for last few years. And we believe that if we continue to execute the way we are executing currently, we will be able to deliver a similar revenue growth for both segments going forward. So yes, 200 crores of distribution segment, 500 crores of ARR is something which is our immediate next big stop.
And Ashishji, just to further prod you into this, it would be great if you could throw some light that once we have the Prop Tiger business also into our thing, which we have done for this small bit in this quarter as well, how we are going to leverage some of the other skill that we have on the distribution. Is there a way to leverage the Analytica also into the PropTiger business? Is there something which while the earlier founders or operators were not leveraging, which we could do and speed up the growth on the PropTiger side of the business?
We believe that there's a direct synergy between Analytica and PropTiger. And that is why, to start with, we have made a common management team to integrate them together. It's still very early days, Rahul. So I think the real thing is in execution, right? But I think strategically and from a vision point of view, it makes tremendous sense. We have started to see some synergies already in the first 15-20 days that we have kind of started to take over the management. But as you know, Rahul, specifically, that even with Nestaway, we took it through a journey, and we ensured that we get profitable very quickly with Nestaway, and then start integrating it with Hello World. So I'm assuming that PropTiger will also go through a similar journey. But as far as the synergies are concerned, Analytica and PropTiger have uh, uh, have great synergies.
Got it. Got it. And this profitability aspect that you touched upon, is it basically 2 to 3 quarters should be a good timeline for it to turn profitable?
Well, we are a bit impatient in turning around the companies, and we are a bit impatient in seeing the profitability earlier. So yes, 2 to 3 quarters can be a great target for seeing a profitable turnaround of PropTiger.
Interesting. Thanks a lot. That's pretty helpful.
Thank you so much.
Thank you. Our next question comes from text questions, and the question is from the line of Mr. Rahil S. from Sapphire Capital. And the question is key growth drivers going ahead for H2. What is the revenue and PAT guidance for FY26 and FY27?
Thanks, Rahil, for your question. We see three key levers to our growth in H2. One is the rental uptick in cities like Bangalore. We are also looking forward to the scaling up of the resale model in Nestaway. Um, Additionally, the new geography that we have opened up at Nestaway, which is Dubai, is also supposed to get a substantial quantum of revenue in the next 2 quarters. Uh, in the distribution segment, purely products. Analytica has launched a new recommendation engine for leads that is supposed to generate a more precise lead for real estate projects and developers. We see that this will increase our price per lead in the midterm to long term, and also effectively increase the revenue and retention of existing clients. Seldu has started its AI chatbots, started onboarding enterprises for AI chatbots. This is one key area of our revenue growth in the Seldu business. At PropTiger, we intend to now scale up the mandate business as well, in addition to AOP. PropTiger presently was largely in doing the AOPs for real estate projects. Now, in addition, we should be also doing scaling up the mandate business. So these are the three areas that we feel will get more revenue in the next 2 quarters. As far as guidance, I think we are not allowed to make forward-looking statements. But if you look at the last 4 years, we have consistently delivered a growth of 35%, and we'll continue to do that effectively. We have our eyes on profitability and are targeting in the next few quarters. We should be PBT positive as well. To underline this quarter, we've been we've achieved adjusted EBITDA positive growth, and we will now keep PBT as the next milestone to reach profitability.
Thank you. We'll take the next voice question from the line of Anubhav Anil Goel from Cosma Ventures. Please go ahead.
Hello, is my voice audible?
Yes, sir, you're audible. Please go ahead.
So in Hello World, I just wanted to understand, we basically own the inventory and take the occupancy upside and risk, right? So we pay a fixed minimum guarantee amount to the property owner.
Thanks for your question. A little clarity on this model. Hello World is a completely asset-light model. We do not own the inventory. We purely take it on a lease or revenue share model. 80% of our properties are on a lease model, where we acquire lease for up to 5 years from property owners to manage their properties and generate demand for them. 20% of our properties are in the revenue share format. We have not gone on to the model of any minimum guarantees because we purely believe that the assets rental value should be organically discovered by tenants and consumers.
So sir, you mentioned 20% is revenue share. So for the remaining 80%, if our occupancy is on the lower side, so does the property owner then get a certain minimum amount, or it's in a way linked to occupancy only?
So balance 80. So the 80% are on pure lease model, where we pay a rental lease to the property owners for the properties that are acquired as lease, and we in turn sublease it to tenants.
So sir,
In case of
sorry sir,
yes, please.
that amount would be fixed, right? For the remaining 80%, the lease
That
amount
amount
will.
is fixed. That amount is
Correct.
fixed.
Okay, okay, got it, got it. So, sir, globally, I think so. Our preference would be more towards to getting the 20% revenue share higher, right, versus the 80%, and linking it to revenue.
Ideally, yes, but markets dictate which model do we go for. For example, difficult markets, we are able to achieve revenue share as the properties are difficult to generate demand at. However, attractive markets where demand for those properties are higher, we are obliged to go with the lease sublease model.
Got it, sir. So, sir, in general, a property owner would prefer a lease model versus a revenue share model.
That's correct.
Okay, okay. All right, sir. Got it. Thank you so much.
Thank you. We'll take the next text question from the line of Vishal Gajra from Ambit. And the question is, at what valuation multiple of revenue did the PropTiger acquisition happen? Also, what are your further thoughts on the acquisition? Which type of companies, what ARR, etc.?
Hi, Vishal. This is Rehan here. Thank you so much for your question and welcome on the earnings call, conference call. Uh, PropTiger valuation was approximately at 1x revenue valuation. For the last financial year, the revenue was at 85 crores. So it was at approximately 1x revenue valuation. Now, with PropTiger acquisition, we cover the rental and distribution value chain. In rental, we cover from student living, young professionals to family rentals. And in distribution, we cover the entire value chain, which is lead generation, lead management, and transaction management. We believe that these two growth engines as such, which is a rental ecosystem and the distribution ecosystem, is poised to grow ahead. We actively engage with companies and look at newer business models that are coming into the space. However, we feel that we have a good enough value chain to go ahead with a future growth strategy. Thank you.
Thank you.
Thank you.
We'll, we'll take the next text question from the line of Jimit G. And the question is, what is the reason for the swing in unallocable expenses?
Uh, uh, the movement in unallocable expenses, the movement in
Sorry to
unallocable
interrupt,
expenses.
sir. Your audio is not coming through loudly.
Yeah. Is it clear now?
This is much better, sir. Yes, please go ahead.
The movement is unallocable expenses is primarily due to the movement between the other income from 8.56 crores from the previous quarter to 516 crores for the quarter ended September 30th, 2025, which is amounting to 3.40 crores. And this reduction in other income is attributable to the Integro asset management company, which we have discontinued consolidating with effect from 30th September 2025. And that is why this there is a swing uh, in the unallocable expenses. Apart from that, there is a small uh, other income to the tune of 40 lakhs, which was the interest earned on IT refund in one of our subsidiary K2V2 Technologies Private Limited in Q1, which is not there in the current quarter. So collectively, this 340, 3.40 crores, 3 crores coming from Integro, and 40 lakhs coming from IT refund from K2V2 is contributing to the swing for the unallocable expenses from quarter one to quarter two. Thank you.
Thank you. Our next text question comes from the line of Rahul Kumar Paliwal from SFO. And the question is, reflecting on the past 2 years, what have been the biggest strategic missteps or underperforming bets, and what changes were made in response? Conversely, which areas have shown unexpected traction or profitability sweet spots, and how are these being exploited for future growth?
Thank you, Rahul, for your question. Um, Strategic mistakes and underperforming bets, I'll not create two separate buckets, but uh, student living was a little bit of a dampener. We had expected that student living will grow multifold for six to eight quarters back. However, because of certain macroeconomic uh, headwinds, student living as a sector has faced challenges, and this is where we were not able to accelerate. We had to move substantial inventory and resources from student living cities like Kota, which we were looking to go big on, more specifically go into a PropCo-OpCo model and acquire more supply. Fortunately, we have always been nimble-footed, and that allowed us to not incur large losses or hits because of this headwind in the student living sector. The other I would say learning has been rental SaaS. Rental SaaS, from an enterprise standpoint, has not delivered the growth expected. We had expected that rental SaaS will grow to across in India and abroad, will grow to at least 3 million revenue in the by this time. However, it has at some point of time now stagnated, and we have put our thinking caps on to solve this problem statement. Uh, the third one is I would not say it is a strategic mistake, but probably we went faster in the fractional ownership segment, and coincidingly, the SM REIT regulation also came in at in a quarter or two, and that now leaves us with the fractional ownership inventory, which we need to sort of deal with, and of course then onboard fresh inventory for the SM REIT model. So these are the three areas that were typically in the same buckets of underperforming bets or strategic mistakes. What has been surprising definitely is the growth that Aurum Analytica has been able to deliver. We had not expected the scale of Analytica, but they have tremendously shown grown and shown promise in the data analytics driven lead generation business. The other surprising factor, or rather not surprising factor, but the other good performing asset has been, of course, Hello World. Hello World has also not just, I mean, if you look at the entire co-living industry, you can look at the peers of Hello World. Everybody has grown, but at the cost of losses. Hello World has maintained that robust momentum of growth without incurring substantial losses. And kudos to the team there who's been able to show that discipline. So, if I had to summarize, these are the five things that we can put in the strategic mistakes and good bets.
I think Sell.do also, because of the restructuring that we did, that company also turned around K2B2 very well. So there we could bring down our losses. The capital that was getting got stuck was recovered quite fast, and the company become positive within say 2 quarters. So Sell.do also was a good uh, call that we have taken at that time.
Right. Kunal is referring to the restructuring of Sell.do. That restructuring helped us put focus on Sell.do as a tech business and dealing the services business from that, which was possibly a strategic mistake when we commenced onto it, but we were able to course correct it quite fast and turn this around. Sell.do has now shown good growth, and the teams are also geared up to deliver fabulous tech for real estate. Thank you. I hope we've been able to answer this question.
Thank you.
Thank you.
Our next question comes from Mr. Rubin Matthews from Equity Intelligence. Please go ahead. Mr. Rubin Matthews, your line is unmuted. You can unmute the line from your end and please
Yeah,
proceed with your question.
yeah. Can you hear me now?
Yes, sir, we are able to hear you.
Yeah,
Thank you.
okay.
Please go ahead.
Yeah, hi. Congrats on good results this quarter. I had two questions. One is on the SM REIT. I believe you had mentioned that you wanted to follow a wait and watch approach. I just want to understand why not try to capture the market now. Be the first mover and take advantage of that. You spoke a bit about inventory for the SM REIT. Can you just elaborate on that also?
So, sir, here I think the type of supply plays to our advantage and helps us to wait and watch. The SM retailable supply across the country is around 38,000 million square feet. These are typically strata sold assets across multiple metro cities where there are good occupiers, strong rentals, and good contracts. So the supply is not going anywhere, and we can what we definitely need to look at is how is the investor traction building up for the SM REIT instrument. We are seeing slow uptick. Once we see certain volumes in that, we should be able to look at going to market in the SM REIT.
Just
Okay.
to add, this
Okay.
is Rehan here. With REITs,
Mhm.
the regulation came out in 2014, and we've seen the evolution of the regulation over this entire journey till 2025, when we had the largest REIT IPO that came out recently in August. We believe that SM REITs will also follow a similar journey where the regulation and the product as such is will mature. We have just seen two SM REIT IPOs till now, and we believe that we want to be the longest and the biggest SM REIT player in India, while ensuring that we get cater to the supply and also the kind of product that the investors would want.
Okay. Okay. And just one question on this Nexter Dubai. I just want to understand that business model a little better. So how do you operate? Can you help? Can you elaborate on onboarding clients and typically how do you win contracts?
So Nester Dubai is similar to Nestaway India, or rather Nestaway, where we provide rental and property management service to property owners and tenants. The Nestaway platform offers the discovery of properties for tenants, and for property owners, of course, an avenue to list their properties and get tenants discovered. Um, we don't stop here. It is not merely a digital classified. We go on to further fulfill the rental transaction by the way of ensuring that there's fair negotiation, there's right documentation and closure, diligence and closure. And of course, tenants are then handled across move in, move out. Further, we also go on to manage the property till the time the property's relationship is with us, which is typically 5 years. And we get for this we get 8% commission for each rental that is paid by the tenant to the landlord. We also take move in, move out charges, which are in a way covering the host of services that we provide to enable the transaction. Nestar is similar to that. Um, what is different definitely is that Dubai is a high value market, much more
Mm.
um, organized, and also I would say mature in terms of rental demand. And
Mm.
that is why we thought, let's take the tech, let's take the brand, and let's take our processes to a market which can give us higher value for the same business model.
Yeah, definitely. Yeah, Dubai is the high value market. So just maybe any guidance on how much you expect maybe from Nestar in the next year? Maybe anything you can give as a guideline?
So it's early days. We have gone and done some key things, which is corporate actions like forming teams, taking offices, and doing the first few GTMs. We would treat this as a POC for another quarter, and then of course go on to scale up. But it's early days for us to pinpoint what what is the revenue growth. However, most of the Indian broking businesses have got substantial revenue coming in from these markets. Without naming them, one of the broking businesses, which is in primary sales, generates up to 60% of their revenue from the Dubai market, and that is a testament of the potential it carries. The said broking business does approximately 800 crores of annual revenue, but it's a pure broking business. Just for your information.
Fair. Okay. Thank you so much.
Thank you. Our next text question comes from Sunil M, an investor, and the question is: are you obliged to buy leads from housing.com after the REA partnership?
Not really. We are not obliged to buy leads from housing.com. This is one of the limitations that PropTiger had initially when they were a part of the REA group, where they were obliged to buy leads from housing.com, and they had in a way, an embargo to not buy leads from other aggregator website or digital classifieds. So now that that limitation goes away, we have a long-term contract, of course, with housing to purchase leads at a fair value, of course at a price that we have negotiated with them. However, we will also have similar contracts with other aggregator websites, making sure that our lead channels are multifold and we are able to get that top of the funnel to close transactions.
Thank you. We'll take the next voice question from the line of Faisal Hawa from HG Hawa and Company. Please go ahead.
Sir, have you ever taken some kind of a valuation as to what Hello World, Nestaway, and Aurum Analytica would be worth if we were to go separately to a private equity fund or to a VC fund? Because I find that a lot of our competitors, which are just a little bit ahead of us in terms of revenue, but very much behind us on profitability, are valued at almost 3x to 4x our entire value. Can you just give an idea, like if or even if you could give it to me subsequently, that what are the three biggest parts of our business, which is Nestaway, Hello, and Aurum Analytica, if we were valued separately by a private equity fund on the same metrics as the other unlisted players, what our valuation would be?
Fazil bhai, this is Ashish here. So we keep doing this evaluation internally. Of course, every time there is a funding round that happens on the private equity with any of the companies in PropTech, our research team does kind of make that comparison. And you are absolutely right that delta is 3 to 4 times of the current valuations that we have. So most of the companies are at 4 to 8x of revenue in the private equity side. Also, what is pertinent here is to that these companies are not making profit, and that is why they are sort of getting the private equity funding, and they are constantly raising various rounds. Whereas for us, each and every product of ours is profitable or is very close to profitability with a very clear line of vision for profitability and increasing the profitability metrics. So the quality of the revenue that we have in the PropTech ecosystem, in our PropTech ecosystem, is far higher than the quality of revenue that some of the companies in private space have, and they are of course valued at a lot more. But yeah, look, we are a public company and we are building it for profitability. We are building it for a longer term enterprise, and that is why our thought process with capital and with its deployment for long term is very different than our private equity space.
In your mind, is it that you will have one of these three businesses becoming really large, and then those cash flows will be probably used to build up the other two businesses, or is it in your mind that one of these businesses could become very large and then you demerge get accordingly so that we get as the shareholders full value for our investments.
As far as the business side is concerned, we believe that Hello World, Nestaway, Prop Tiger, Sell.do, Analytica, and SMD, all the six businesses will become extremely big, and they have shown that sign. They have shown those maturity. We believe that heavy lifting in all these six businesses are already done, not as much as in SMD, but in the other five even more. In SMD, since the licensing process is done and the TAM which Onkar spoke about is already so large, we believe, and because we come from the real estate side, we understand real estate business. We believe there also we are in a great position to become the largest in the country. So our belief is not restricted to one or two of the companies. Our belief is across the six companies and the six products which are going to be very big. Even a very small product of ours, which is loan origination, is showing great promise. So there is a huge demand that is yet unmet in the country that needs to be serviced and served. We have to do it responsibly. Responsibility say, I mean, we have to do it with a better capital deployment, and that is what we are trying to do quarter on quarter.
Thank you very much, sir.
Thank you, sir.
Thank you. Dear participants, while we do have some more questions in the queue, due to paucity of time, we will have to conclude this call today. I now hand the conference over to Vanessa for closing remarks.
Thank you, Sagar, and thank you everyone for joining us today. Quarter two has been a meaningful step forward, one that reflects our continued focus on disciplined growth and sustainable profitability. As we expand our footprint and strengthen our ecosystem, we do so with renewed conviction in the long term value we are creating together. We look forward to staying connected with all of you and sharing our progress in the quarters ahead. Please feel free to reach out to our investor relations team, and we'll be happy to take any further questions offline. Thank you so much. Wishing you and your families a very happy Diwali.
Thank you. Thank you very much to the members of the management. Ladies and gentlemen, on behalf of Aurum Proptech Limited, that concludes this conference. Thank you for joining us, and you may now exit the meeting.